So let us get started with the MCQ questions of section B. Section B, to be more specific, of part 2, CMA US part 2. So here's our first question number 163. Country R's currency would tend to depreciate relative to country T's country currency when? So R's value would go down when comparison to T. That's what is he's saying. Now that will happen if country R switches to a more restrictive monetary policy. See, if country R switches to more restrictive monetary policy, it means that, there would be more, there will be more regulation in place. There will be more rules and regulations in place. When there will be more rules and regulations in place, then why will the currency value depreciate of R? I don't think so. That can be the answer. So I'm scrapping that out. Then country T has a rapid growth in income that causes imports to lag behind exports. Now, country T has a rapid rate of growth in income that causes imports to lag behind exports. It is fine, but where is the relationship shown between T and R? See, in that manner, country T's currency might appreciate, but in comparison to what? I don't think so. That's framing in the answer. If in this option, it would have said that, in comparison to, in relative to country R, currency R, then we could have thought about it as an answer, but I don't think so. This can be. Then country R has an inflation that is lower than rate of the inflation in country T. See, in this case, if suppose you are having more inflation, it means that your value is depreciating. But here, the inflation is lower than country T. So it is appreciating. Now coming up towards the last option. Country R has real interest rates that are lower than real interest rate in country T. Now this makes country R less attractive. It means that the value of currency R will depreciate in comparison to country T. And I think so this should be the answer. How many of you agree? I saw one option answer in the section, in the answer section as C, some students said. So see, this inflation, if they had more, okay, if they had more inflation, then the currency value would have depreciated of R. But here inflation is lower compared to country T. That's the reason it cannot be the answer. Is that clear? All right, sounds good. Let's go back. Remember, see, we are going backwards while doing these questions. Now, country A's currency would tend to appreciate relative to country B's currency when? See, this appreciate and depreciate of country A, country B is like 100% damn sure question going to come in your examination. The more you practice it here, the much better it is for you. Now, if you see here, country A has a higher rate of inflation than country B. Now, if you see here, what's happening? Country A's currency would tend to appreciate relative to country B. It means their inflation rate, should be low. But here, if you see, country A has a higher inflation rate. Now, when they have a higher inflation rate, it means that the currency is going to depreciate. So it does not form with the answer. Then country B has real interest rates that are greater than real interest rates in country A. So even in this situation, when you're having real interest that are greater, it means that the country B will appreciate. Okay. Country B's currency will appreciate. Then if you just see in here, option number D, I just saw it in the chat section, someone answered D. Country B switches to a more restrictive monetary policy. Even if you see here, if you are going towards a restrictive monetary policy, country R switches to a more restrictive monetary policy, it means that country R is appreciating. I just said it in the earlier question. Even if you see here, country B, he is appreciating, it means it is not forming with the question at all. Question is asking A is appreciating to B, not B is appreciating to A. So in this, B's value is appreciating. And then in when I've cross marked option A, B, and D, option C is what it remains. So country A has a slower rate of growth in income. So what will happen? That causes its import to lag behind its exports. What's it? Country A has slower growth in income that causes its import to lag behind its exports. So you are selling more and you are buying less. Selling more, buying less, your currency would tend to appreciate relative to B. Are you guys there with me? Everyone there with me? So in short, if country A has more exports than imports, its demand for foreign currency will diminish, resulting in the appreciation of A's currency. Okay, let's move a bit more forward. Next, if the US dollar appreciated against the British pound, other things being equal, we would expect that what can we expect if the US dollar appreciated against British pound? What will happen here? The British demand for US products would increase. The British demand for US products, no, because US dollar has appreciated, not the British pound. US demand for British products would decrease, no, it will increase. So US demand for British products would increase, yes, it will increase. Trade between US and Britain would decrease, why will it decrease? It does not make sense at all. So the answer here is C. Everyone there with me? This appreciation, depreciation is a really, really important concept for your, CMA Part 2 examination. For sure, you're going to get questions in this. Okay, now, under a floating exchange rate system, which one of the following should result in a depreciation of Swiss franc? Now, first of all, what exchange system you are using here? Floating exchange rate system. Which one of the following should result in a depreciation of Swiss franc? Tell me. I'm giving you the option to say this answer. Depreciation in the value of Swiss franc. Let's see from these options. Decrease in outflows of Swiss capital to the US. If this happens, then it will appreciate because decrease in outflows of Swiss capital to the US, it will appreciate. Swiss interest rate rise relative to the US rates. Now, if Swiss rates is rising, then it is again rising. US income levels improve relative to Swiss. When income levels is increasing, it is fine, but it does not mean that the Swiss value is going down. Should result in a depreciation of Swiss franc. US inflation declines relative to the Swiss inflation. This is the time where you can say that I think so. Yes. This what answer do you want to get? I don't think so. B can be the answer. The US level in income levels improve relative to Swiss. No. The currency, see, you are using a floating exchange rate system. So you are going in your own manner, your sales and purchase in the system. Here, this one, US inflation declines relative to Swiss inflation is the answer for you. Now, moving forward. K Inclusive has issued 25,000 shares of its authorized 50,000 shares of common stock. Okay. There are 5,000 shares of common stock that have been repurchased and are classified as treasury stock. K has 10,000 shares of preferred stock. If a 0.6 per share dividend has been authorized on its common stock, what would be the total common stock dividend payment? What can it be, the total common stock dividend payment? Come on fast. I'm giving you the opportunity right now. If you see here, how many were issued? 25,000. Then if you see there, 5,000 shares of common stock had been repurchased and they are classified as 10th, treasury stock. So basically it is reduced 5,000. So this becomes 20,000. Then this 10,000 is preferred stock. That does not come towards the common stock dividend payment. Then 0.6 per share is given. So it's just 20,000 into 0.60. That equals how much? 12,000. Is that the answer? Yes, it is. Now, going more further. Now here we have come towards cost of capital. Now, whenever we have a question like this, what we need to do is read the requirement. The best reason for opting for a stock split is that. So what can be the best reason for opting for a stock split? Now, look in here. Underhaul Inclusive's common stock is currently selling for $108 per share. Underhaul is planning a new stock issue in the near future and would like to stimulate interest in the company. The board, however, does not want to distribute capital at this time. Therefore, Underhaul is considering whether to offer 2-for-1 common stock split or a 100% stock dividend to its common stock or to its equity shareholders. The best reason for opting for a stock split would be what? Now, here I guess it's kind of a general question only. These all doesn't matter. See, it will not decrease shareholder equity. It will not impair the company's ability to pay dividends in the future. Yes, can be the answer. The impact on earnings will not be as great. Well, what would be the impact on earnings if you are doing a stock split? So yeah, even a partial one won't be there. Then the par value per share will remain unchanged. No, this cannot be because par value per share will change in there, right? What do you guys say? A or B? C also I'm not convinced with it. Does not make that it's not a discrete answer. A or B? It will not decrease shareholders' equity is fine, but it will not impair the company's ability to pay dividends in the future. Yeah, I guess this should be more convincing because see, it will not decrease shareholders' equity is fine. That does not make this statement does not make a major change into our consideration towards stock split. See, If you are going for a stock split, you will say that it was not decreasing the shareholders' equity. It is fine, okay. But it will not impair the company's ability to pay the dividend in future. Yes, this can be, a better reason for going for a stock split. So this is going to be your answer for sure. Now, moving forward. When determining the amount of dividends to be declared, the most important factor to consider is the expectation of the shareholders, future planned uses of retained earnings, impact of inflation on replacement cost, future planned uses of cash, or I can also ask, all of the above or something. What are you going to do when you're deciding for the dividends? Expectations of the shareholders, are you sure? See, remember, or just be specific here. Most important factor he's saying. Most important factor. If you see, all four options looks good only. If there was an option E, which was talking all of the above, I would have gone with all of the above. But here there is one answer. And it's pretty general. I can see it in the chat section. Yes, it is future planned uses of cash. Yes, that's pretty general, but see, what are you going to do with your cash in hand? Do you have any good opportunity? Invest it there. If not, then what are the expenses? What are the uses of cash going to be for in the near future? That's going to be really important. Okay, so option D is the answer. Now, what is this question? How much in dividends would the company likely pay? So here's again the cost of capital. How much in dividends would the company likely pay? This is a question from the cost of capital. Mason INC is considering 4 alternative opportunities. Required investment outlays and expected returns for these investments are given below. Investment 200,000, 350, 570, 390, IRR 12.5, 14.2, 16.5, 10.6. The investment will be financed through 40% debt, 60% common equity. Internally generated funds total 1 million are available for reinvestment. If the cost of capital is 11% and Mason strictly follows residual dividend policy. Residual means whatever is remaining at the end, that will be given away. How much in dividends would the company likely pay? How much in dividends would the company likely pay? Now, if you see here, what is he saying? Investments are financed through what? 40% is debt, 60% is equity. So if you just see here, what is this complete investment which you have to make? Just look into this. If you see here in this question, he has given cost of capital is 11%. When cost of capital is 11%, tell me which of the projects will be approved first of all. Out of these, what projects will be approved? A, B, and C. This is below the cost. This project will not be approved only. So how much amount you require is this much. 200,000 plus 350,000 plus 570,000. That equals to 1,120,000. This is the amount you are going to invest. And that too, this amount is going to be financed by 40% is going to be debt, 60% is going to be equity. And we are considering dividends now. So let us just take our 60% out of here. Everybody with a calculator. I am having a calculator with me and I am doing it. 1120000. 1120000 multiplied by 60%. 672,000. Okay. I have this 672,000 with me as the equity, which I am going to do. Out of this 672,000, if you just see in here, the 100,000, okay, 100,000 is my retained earnings. Now 100,000 is my retained earnings. Out of this 100,000, I'll remove this 672,000. Whatever is the requirement, I'll just remove it. Minus 100,000. Sorry, minus 1 million. It gives me 328,000. So if you just see in here, residual means whatever is the amount finally remaining, that amount that will be available for dividends. So if you see here, 1 million minus 672,000, which is the requirement for the investment in the project. I've invested there. Remaining 328,000 with me. I'll invest, or this is available. Okay. I'm not saying that I'm going to pay all this in dividends. This is like available for dividends. Okay. This amount is available for dividends. Now, how much you're going to give? That's a different issue for you. Everyone there with me? Hello? Yes, then put down a yes in the chat section. I hope that you guys are following up with this session. Yes, let's move forward. 2 questions in front of us now. Let us do 154th first and then 155. If you see here, what is the effective annual interest rate for 1 year 100 million loan with a stated interest rate of 8%? If the lending bank requires a non-interest bearing compensating balance of 5 million. So if you just remember this, what is the formula? See, your interest rate is 8%. You have to find out what effective annual interest rate. So in this case, what do we need to do? We have to take this 100 million, multiply it with 8% and divide it by the principal amount minus this 5 million, which is the compensating balance. So if I just do 100 minus 5, 95 million. Now, if I just do this simple calculation, okay, 100 million into 8% is going to be 8 for me. So 8 divided by 95 is how much? 8 by 95 is equals to 0.0842 multiplied by 100 is equals to 8.42. 8.42. Is it there? Yes, it is. Simple, right? Remember this. See, effective interest rate, calculate the interest, and whatever is the interest amount divided by the principal amount, you will get it. Effective interest rate. Then if you see here, question number 155, the residual theory of dividends argues that dividends, what do? We have just done this. Necessary to maintain the market for common stock? No. Are irrelevant? No. Can be foregone unless there is an excess demand for cash dividend? I don't, what is making sense. Can be paid if there is income remaining after all attractive investment opportunities have been funded. After you have done, you've invested your money elsewhere in the most profitable manner, if it is money remaining with you, that you can pay it in dividends. Is that clear, everyone? I hope everyone there with me and following up with this sessions or this particular session. Kind of interesting also, right? Then question number 153. How much will frame pay to the bank next year in interest and fees? How much will frame pay to the bank next year in interest and fees? So see, these are the keywords which we need to keep in our mind while reading this complete full question. Next year, interest and fees, how much is it going to pay? Fine. Now, Frame Industries has arranged a revolving line of credit for the upcoming year with a commercial bank. The arrangement is for 20 million with interest payable monthly on the amount utilized. So 20 million is the line of credit. Whatever amount you're going to realize, you're going to pay interest on it. Now, bank's prime rate and an annual commitment fee of 1/2 of 1%. 1/2 of 1%. Computed and payable monthly on the unused portion of the line. Frame estimates that the prime rate for the upcoming year will be 8% and expect the following average amount to be borrowed by the quarter. By quarter, you're going to borrow this much amount. So if you just see in here, the amount which you borrow, you're going to pay how much? 8% per annum interest. The amount which you don't borrow, you're going to pay how much? 1/2 of 1%. Okay. Everyone there with me? Yes. Now tell me what can be the calculation for this. I'm just giving you guys the opportunity. What can be the interest? 8% it is. If you see, this is the amount borrowed for 1 quarter. 1 quarter, you're going to pay it in 1 quarter only. So it would be 10 million into 8% into 3/12. Then this 20 million, again, you're going to take 8% into how long you're going to keep it for you. Or just see in here. So per quarter, if you're borrowing this much, it means that you have got back. Yeah, into 6/12. Then 8% into how much? Okay. So this complete 20 million I'm doing 6/12. And this 5 million again into 8% into 3/12. Everyone there with me? No, not 9/12. First, tell me this 10 million into 8% into 3/12 is equals to 10 million into 8% into 3/12 is equals to 200,000. And even this is again 3/12 only. 20 million. Okay. 20 million into 8% into 3/12 is equals to 400,000. And this one also is going to be 400,000 again. And then this one, 5 million into 8% into 3/12 is equals to 100,000. So in short, in interest, okay, in interest, you are paying how much? 2, 4, 8, 1 million. 1,100,000. In interest, you are paying 1.1. Now, what about the fees? Fees is the commitment fees, which you are paying half percentage. So if you see here, this time you're using 10 million and 10 million is unused. So 10 million into half percent. 10 million into 0.005. Now, this is again for 3 months per quarter only, into 3 divided by 12. So in this, it is going to be 12,500. I'm doing it with my own calculator. I expect you guys also to do it. In the second month and the third month, you're utilizing the whole amount, so you don't have to pay any commitment fee for the unused amount. Then in the fourth month, you're using only 5 million. So unused is how much? 15 million. Now 15 million into half percentage into 3 by 12. 15 million into 0.005 into 3 divided by 12 is equals to 18,750. 12,500 plus 18,750. 12,500 plus 18,750 is equals to 31,250. Now this 31,250, I'll add it here. How much is it? 1,100,000, 131,250. 1,131,250. That is an answer here. I hope everyone is able to follow up here. If yes, then put down a yes in the chat section. Because what I'll do now is we'll pause our session for today. Why is it 3 by 12? Is because it is just for that quarter and you're going to almost pay that back only. If you see here, 3 by 12 is just for the quarter, right? One quarter is 3 months out of 12 months. If you see here, it is a revolving credit line for the upcoming year. Now, when it is a revolving credit line, you're using it, you're repaying back. You're using it, you're repaying back. So as and when a quarter is over, you're having again a portion to pay for it. And it's also assumed that you've repaid it back. Not assumed directly, but based on these lines, we can understand that it is going to be next month again used. It's like first quarter you use this month, second quarter, third quarter, fourth quarter. You are paying back. Or even if you don't pay back, it is understood, right? That 10 million. No. But second quarter is 3 plus 3 second months. No. See, anyhow, this is going to be for this quarter only, this 10 million. That's going to be for the amount borrowed for first quarter. Whatever is the interest for that first quarter, we calculated. Now, what is going to be the interest for second quarter? You have already borrowed 20 million. Then what's going to be for the third quarter? You have already borrowed 20 million. So what is the interest for it? And then in the fourth quarter, what is the amount borrowed total? Is 5 million. So that's going to be the remaining. So on each quarter, we have done that. Now, if you see, interest payable is monthly on the amount utilized. So what I will do right now is I'll pause our session and we'll continue the remaining questions tomorrow. Tomorrow in the sense in the next class. In the next class, we are going to continue these questions. I expect you guys to go through the previous recordings of the conceptual explanation Once you have more conceptual clarity, then you're going to do all these problems with ease. If you see here, next are more problematic questions only. So be ready for it. Try going through a lot of conceptual clarity through the previous sessions which we have done, so that you have confidence while solving these questions. Okay. And I'll see you guys in the next session.